Now, John Bowman, who's the Acting Director of the Office of Thrift Supervision.
Good afternoon, Chairman Frank, Chairwoman Velasquez, Ranking Member Bacchus, Ranking Member Graves, and distinguished members of the committees. Thank you for the opportunity to testify today on behalf of the Office of Thrift Supervision. I think we all recognize that banks and thrifts remain under tremendous stress due to continued declines in home prices, high unemployment rates, pressures on commercial real estate, and the improving but still hobbled secondary market for mortgages. We need look no further than the high levels of delinquent loans and home foreclosures and the increasing number of financial institutions that are troubled or failing under the strain. As a counterweight to this stress, financial institutions are building capital levels and loan loss reserves, thereby making fewer dollars available to lend to consumers and businesses. No one wants to return to the days before the recession when too many loans were made using underwriting criteria based not on the borrower's ability to repay, but on the value of the collateral, value that we now know was fleeting. But we also recognize the economy will not recover fully until financial institutions resume lending at levels that can help sustain a thriving economy. Many sources of credit before the recession, such as highly leveraged and under-regulated non-bank businesses that often maintained loose underwriting standards, have gone out of business. Their departure from the marketplace leaves borrowers more dependent than ever on regulated banks and thrifts, and as a result, lending by these institutions is more essential. The question before us today is whether banks and thrifts are tightening credit to an unreasonable level beyond what is prudent for safety and soundness, and what regulators can do to ensure that the financial institutions they regulate strike the right balance between lending and safety and soundness. I have seen some executives at banking institutions quoted as saying that they want to lend more, but that their regulators won't let them. In some cases, that is certainly true. An institution with soaring levels of bad loans and insufficient capital faces the all too real prospect of failure if capital and loan loss reserves do not increase. And to state the obvious, a closed institution doesn't make any more loans. The regulator might be painted as the culprit in restricting lending, but on the other hand, the regulator might also succeed in helping the institution return to a healthy condition so it can resume meeting the financial services needs of families and businesses in its community. For healthy institutions, let me make clear that the OTS is encouraging all types of loans allowed under the Thrift Charter, as long as thrifts follow prudent underwriting standards to ensure each borrower's ability to repay. The OTS and other regulators have made this position very clear to regulated institutions twice in recent guidance, and at the OTS, we have taken several steps outlined in my written testimony to make sure our regional offices and examiners in the field are in lockstep with Washington on this issue. I also noted in my written testimony that small business lending is fully consistent with the mission of the thrift industry to serve America's consumers and communities. However, thrifts are limited by law in the amount of small business lending they can do. This restriction makes less credit available to small businesses, and although the House Financial Services Committee has voted 3 times to remove the cap on small business lending, and the full House has passed it twice, this provision has never been enacted into law. Thank you again for having me here today, and I'm happy to answer your questions.
We have an hour and 35 minutes with this panel, and I am